Hey everyone, in today's video, we're going to walk through exactly how your Social Security benefits will be taxed in retirement. Now, this is a complex topic. Social Security taxation is quite confusing. I see a lot of retirees confused by this. So we're going to be using examples. We're going to walk through a few of those examples showing exactly how Social Security is taxed. So everyone watching this video understands how their benefit will be taxed and understands how tax preference of an asset Social Security is. So before doing that, however, if this is your first time on our Safeguard Wealth Management YouTube channel, if you've liked some of our content before, if you've watched some of our content before, up to 70% of the people that watch our content aren't subscribed, which means when we're releasing new videos, you're not notified of the new videos that we're releasing. So go ahead, hit the subscribe button. You'll be notified of all future videos that we release. We release videos weekly on how you can improve your retirement, improve the assets that you already have, get more out of the assets that you already have. So let's go ahead and get into it. Let's explain the the complex way the IRS taxes your Social Security benefits. So everything is based off this formula right here. It's called provisional income. You'll often hear this quoted or talked about in relation to Social Security taxation. Okay, and basically you find your provisional income pretty simply. Okay, you include all gross income, all taxable income sources. So this would be income from IRA withdrawals. It would be pension income, annuity income. It would be long-term capital gains. You'd include all of this as gross income on a dollar-for-dollar basis. Okay, then you would add in any tax-exempt income on top of that. So things like muni bond interest. And then you'd add in 50% of your Social Security benefit. Okay, and in layman's terms, basically what's going to happen, the higher your provisional income is, the more of your Social Security benefit that is going to be taxed. And so here's a secret when we talk about Social Security taxation and creating a tax-efficient income throughout your retirement. The more income, again, you have a set amount of income that you need in retirement. The more of that income that you have coming from Social Security, the lower your provisional income will be, because everything else is counted dollar for dollar. Okay, if you have $1 coming in from IRA withdrawals, that's going to be counted as again, dollar for dollar for this provisional income. Same thing for tax-exempt income. The only thing that is discounted and only counted at 50% is your Social Security benefit. So the more that you have coming from Social Security, the lower your provisional income will be, the lower the less you will owe in Social Security taxes. Okay, so basically, then you take your provisional income and you plug it into this table. Okay, at less than $32,000 for a married couple, your Social Security is tax-free. Between this range of $32,000 and $44,000, up to 50% of your Social Security benefit is taxed. And then at more than $44,000, up to 85% of your Social Security benefit is taxed. And so most people think during these provisional income tables, as soon as I cross over this $32,000 mark, instantly it's like a cliff. 50% of my benefit becomes taxable. That's not how Social Security taxation works. Okay, it's gradual. So basically, through this time period, let's say that you had your provisional income was $32,050. Okay, you would only owe 50% of the provisional income over this $32,000 mark. So $25 of your benefit would become taxable given that scenario that I just talked about. Okay, but let's walk through some examples. Again, you just want to know from the start, this is not a cliff. It gradually happens. Okay, but let's walk through some examples to hopefully increase everyone's understanding. So let's say we have a married couple here. They're taking $40,000 from Social Security. They're taking $30,000 from IRA withdrawals. Okay, so how much are they going to owe in Social Security, or how much of their Social Security benefit will be taxable? Okay, well, how do we figure this out? Well, let's type it into this provisional income. So they have $30,000 coming from IRA withdrawals. They have $40,000 coming from Social Security, but remember, we're going to have that. And only $20,000 is going to be included in this provisional income. So we add $30,000 together with $20,000. They don't have any muni bond interest in this given example. So their provisional income is going to be $50,000. Now remember, they're married. So this $50,000 number, we're going to be looking at this married provisional income table here. Okay, so this $50,000 is obviously over this range over here of $44,000. So we know within this 50% taxable range, we're going to be fully taxable in this range. Okay, now there's a $12,000 range here from $44,000 to $32,000, right? That's a $12,000 range. So within that range, 50% of our Social Security within that range is going to become taxable. Okay, so in this range, 50% of $12,000 is what? It's $6,000. Okay, so at the very least, we know we're going to owe $6,000, okay, in Social Security taxability. Or I should say $6,000 of our Social Security benefit is going to become taxable. Okay, then though, we know provisional income is $50,000. That is $6,000 more than this $44,000 threshold. So anything over $44,000 is going to move 85% of that into becoming taxable for our Social Security benefit. So that there's $50,000 is $6,000 more than this $44,000 threshold. 85% of that is $5,100. So we add those together, and this person is taking $40,000 from Social Security. They're taking $70,000 in total income, and yet only $11,100 of their Social Security benefit will become taxable. Basically, a quarter of their benefit will be taxable despite taking $40,000 from Social Security. And so now we start to see how beneficial Social Security can be in terms of tax preferability. Okay, let's go through another example. Example number 2. We have a single filer here. They're taking $30,000 from Social Security. They have $20,000 that they're pulling from their taxable accounts, okay, from their IRAs, let's say. So again, plug this into this formula. We have $20,000 that they're pulling from their IRAs, okay? They have $30,000 that's coming from Social Security, so we have that, and we take $15,000. Add those two together. Sorry, it keeps flipping around here. Add those two together, and we get a provisional income of $35,000. Okay, so again, we would plug that into this table then. Remember, they are a single filer here. They have a provisional income of $35,000. So again, within this range here, they're going to be fully subject, that's going to move into their Social Security taxability. So now this is a $9,000 range. Okay, so 50% of $9,000 is $4,500. Okay, their provisional income then again is $35,000. So we want to subtract out this threshold over here of $34,000. Now obviously $35,000 is $1,000 more than $34,000. And so within this range over here, 85% of that amount is going to become taxable in terms of Social Security. So $850, add those two together, we have $5,350 of their Social Security benefit that is now going to become taxable. Now remember, they're taking $30,000 from Social Security, and a fraction of this is taxable. Okay, 1/6 of it basically becomes taxable. So again, we can start to see how beneficial Social Security can be, how much Social Security can save in terms of taxes. And it's important to understand this. It's important to understand how Social Security is taxed to understand just how beneficial Social Security is in terms of taxes. Let's go through one more example. Okay, and this is an example that we gave in the last video when we talked about 3 reasons most people undervalue Social Security. We gave a taxation example showing a married couple that had $75,000 coming from Social Security, $15,000 that they were pulling from their assets, and they owed something like $330 in federal income taxes. And we had some people reach out and ask, how the heck is that possible? Well, let's walk through and show you exactly how that's possible. Okay, so again, going back to this provisional income idea. Okay, gross income, they're pulling $15,000 from their assets here. Okay, then we're taking half of their Social Security benefit. They had $75,000 of a Social Security benefit, so half of that would be $37,500. Add those together, we get a provisional income here of $52,500. So again, plug this into the table. Again, they're in the married provisional income. Okay, so again, they're going to be fully subjected to this range here. Again, we already covered what that means. That means they're going to owe $6,000, or so they're going to have $6,000 of their Social Security benefit become taxable within this 50% range. And then obviously $52,500 is more than this $44,000 threshold. Okay, it happens to be more than this $44,000 threshold by $8,500. Okay, so if we take 85% of $8,500, we get this $7,225 number, right? Times 0.85, $7,225. Okay, so that's how we calculate out this 85% range right here. add those together. And so this person is going to be taking $75,000 from Social Security. Only $13,225 is going to become taxable. Okay, so how does their taxable income work out then? Okay, so we would add this amount of Social Security taxability to the amount that they're pulling from their assets. So $13,225 plus $15,000. So they're going to have a taxable income of $28,225. Okay, well, the standard deduction, okay, now granted, if this person was filing at 70, they would get the add-on standard deduction. Okay, you get an add-on if you're over 65, but let's just use the basic standard deduction of $25,100. So if we take the standard deduction of $25,100 and we subtract that out of this person's taxable income of $28,225, okay, let's actually do this just with this calculator here. So they're going to have a taxable income of $28,225. Subtract out the standard deduction of $25,100 in 2021, and they're going to have an actual taxable income of $3,125. Well, that's going to then be obviously taxed at 10% range, so they're going to owe something like $300 in taxes. So this person is taking $90,000 of income, okay, and are only owing $300 in taxes, in federal income taxes. So again, hopefully this is eye-opening. One, in how Social Security is taxed, but number two, just how through each of these examples, just how much of a tax preference asset Social Security becomes. You want the majority of your income coming from Social Security because it's such a tax preference asset. Okay, again, as you pull more from your other assets, it increases the taxability of Social Security, which again, relative to the amount of income that you have coming in, you want the majority coming from Social Security. Hopefully this is eye-opening for you. Let me know if you have any questions in the comments below. Don't forget to hit the subscribe button. Again, you'll be notified of future videos that we release. Always remember, you don't need more money. You need a better plan. Thanks for watching.